Everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. Well, the market's continued higher as expected, getting past that December 15th deadline without any new tariffs and actually getting some sort of a phase one trade deal, which does look like something's going to happen. There's been no backtracking since then. And in addition to that, the yield curve is starting to steepen a little bit, which is a positive short term. We talked in the past about the inverted yield curve and how every recession in history had been preceded by an inverted yield curve. But remember, that's 12 to 18 months down the road. So the fact that the yield curve is steepening is a good sign near term. But let's take a look at the charts and let me show you why I think the longs might be getting just a little bit nervous. Before we get to the charts, I did want to show you the yield curve that I mentioned in the intro that has steepened a bit. And as you can see here, this is straight from the U.S. Treasury. And the green line that you're looking at there is the 2-year Treasury. And then that blue line is the 10-year. But what you really want to pay attention to is the line down at the bottom, which represents the difference. So you can see that the zero line is that lower line. And when we broke just below that a little bit in August and September, came close to it towards the end of September, but breaking it there in August and September, that when you break below zero, that means that there's an inversion between the two, meaning that you're actually going to get paid more money to only hold a Treasury 2 years versus 10. That doesn't make any sense, right? You should be paid more interest for holding something longer. That's how it's supposed to work. So that's why everybody goes crazy when you hear about an inverted yield curve. But when you look at the two, you can see there that there's good separation here, as good a separation as we've had in a number of months, and that is a positive short term for the markets. But I also mentioned in the intro that the longs might be getting just a little bit nervous. Now the longs would like nothing else. Those that have been in the market, those that are long the market, that have realized some pretty nice gains with this last run since the market bottom there, tested the bottom in the beginning of October. They would desperately like to be able to wait, hold their positions until after the first of the year, sell and take their gains then, so that they push the tax burden off into the following year. But I really think that they got itchy fingers, and at the first sign of anything negative, they're going to be quick to hit that sell button, take them. Then we talked about in the dichotomy recording about how there's those that have not participated in this rally, that haven't been believers in the market moving to the upside with all the stuff going on. The market seems to care nothing about the whole impeachment thing, and they're chasing performance, and you're seeing that now. We talked about this 78.6% fib level, which isn't historically a strong level of support resistance in the equities world, but so far it's holding really well. And we've broken back above the 100% extension, and we've moved vertically since then. A little too vertically for my liking. I prefer when we go in a 45-degree angle, more like this movement here. These are the moves that tend to hold. When you start to go vertical, those get retraced. And now, on top of the fact that we've broken vertically since we broke that level, now we've got this little gap to contend with, and that may very well get filled in the not too distant future. Is it possible that we just rocket right to that 161.8% level? Yeah, it's possible, but we're going to start moving into a quieter time, a time of the year where people begin to go on vacation. There's not many traders. Volume drops, volatility drops, and the market tends to just creep along. Now, it normally creeps to the upside during this time frame. Even last year with the big sell-off into Christmas Eve, we still crept back up following that Christmas break into New Year, better known as the Santa Claus rally. So it's going to be fascinating to see what happens, but we also have a little separation from the 10-day moving average. And if you've heard any of these recordings that I've done, we talk about all the time, or I talk about all the time, that no security in any time frame gets very far away from the 10-day moving average. It just doesn't. It either comes back towards it or it consolidates so that the 10-day moving average can catch up. Looking at the VIX, we're getting down here into this area around 12, which has acted as support for the past year or so. But again, we're going to get into a quiet time. So normally you would think, oh, we're probably going to bounce and we may have some pretty good down days with a spike in volatility, but we could go through another period of time, which is my expectation. When the market doesn't care what I expect, but my expectation would be that we see something like this, where we went through a good part of October, November. Frustrating time trading-wise if you were a short-term trader, but going through this consolidation period here, and we may just see that into the end of the year. Looking at TBT, we had a bond auction that Rick Santelli, who almost never grades the bond auctions with a high grade, gave an A+. He said he wasn't sure he's ever given an A+ before. Now that sounds like a good thing because you have to pay attention to the bond market, but when you have a bid to cover at 2.69, that means there were 2.69 bids for every Treasury being auctioned. That's what the bid to cover means. That means there was a lot of demand. Why is there so much demand for bonds when interest rates are so low? Are people hedging their bets? Are people getting a little bit nervous about how long this rally has been going? It's interesting, but interest rates are holding in the sweet spot, as we talked about, above this 61.8% fib level. And anytime we hang around in this area without getting too high or without going back down and signaling something negative with the economy, it's all signs are go for the market to move higher. And same thing with the dollar. The dollar is hanging around down here in this lower area of support, and the market likes that because we've got a lot of companies that are multinational, and that helps with the exchange rate, so they like to see the dollar stay weak. So we're in a pretty good place if you're along the market, other than the fact that we might be just a touch overbought at this point in time. We're nearing 2 years now with Elliott Wave Options that we've been posting these free educational videos on YouTube. And if you've enjoyed those, please give us a like or maybe hit subscribe. Or if you'd like to participate or check out participating in the alerts. And obviously our subscribers have had a pretty good couple years. If you've looked at our videos, you see that the analysis has been pretty spot on over the past couple years. Give us a visit at ewotrader.com. ewotrader.com. Look forward to having you come along with us if you're interested. Otherwise, happy holidays to everybody. Talk to you soon.